Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
A few months ago, folks, I did a show, actually it was about 4 months ago, we did a show, it's not just I, it's we're a team, where I said Revere, actually Don Kenobi, broke the planning software. Now, it's time to revisit that. We've had a lot of new clients and questions, and so I want to explain that. Okay, box planning software, they download automatically and update in real time and stuff, and so you see your balances daily grow as they actually are. But the way they do the planning side is they actually have you select the appropriate pie charts or us portfolio, whether that's a 60-40 balanced, which is conservative or moderately conservative, or whether you pick aggressive, go-go, or whatever. And they've got all these indices and mutual funds that you can choose from. And with that, because they've got all the historical data for that, they go in there and they say, oh, well, that means you get a 5% return if you're 60-40, 6 if you're lucky, and you got a drawdown of about 25-30%. However, if you go for the most aggressive, our particular software, and they're all similar, the maximum return they can give you is 7.2%. That's with a 90% risk. You're all in, gas to the pedal to the metal. But with 35% drawdowns. So if you take that 7.2 annualized, long-term annualized rate, divided by your maximum drawdown, that's 0.21. That's called the MAR ratio. We're going to talk more about that in just a minute. But why is that so important? If you get annuity illustrations, if you buy an annuity, don't do it. Sorry, my producer's laughing over there in the background, so it made me laugh. They show you an 8% illustration. I mean, if you've got an annuity, they gave you an 8% almost always, maybe 7, but usually it's 8 on one of those indexed annuities. Folks, that will almost never happen. By the way, the reason they show you that 8% is that's the maximum the regulators will let them show you. But here's the point. At Revere, we're, since Grotection and stuff, we're annualizing 12, 13% long-term, and our maximum drawdown is around 13. We had one that was a little bit slightly more further back, but Don's getting better and better at minimizing the drawdowns. But here's the point. If you take a 13% annualized return and you divide it by 13% maximum drawdown, that's a 1. Why is that so important? So let me explain it to you. If you're nearing retirement or in retirement, and all of a sudden you take a 35% drawdown because we just stay the course, the market always comes back. I'm sure you never heard those before. Anyway, if you go down 35% and you're needing the money and you need to draw it out at that same time, now it's not your 35, 40% drawdown. Now you're also taking another 3, 4, 5% or whatever, using that 4% rule. Recovery is very difficult. So case in point, during the COVID bear market, the market was down 35.5%. We were down roughly 14, I think, 13.5, 14, depending on when people came in, because it's also about your independent sequence, your specific return. But if you're, and then the next year you start having a really good year, well, if you're compounding from down 35%, so now you're compounding from 0.65 or 0.7, and you make those returns next time, you're only getting 2/3 of that new return the next year. See, compounding is cumulative. So with Don, we were down 14, and all of a sudden we start compounding back. A better example is during the inflation bear, 2022. Market was down 28.5%. Treasury bonds were down 30. Bonds are safe, right? Not always. Price is truth, no exceptions, period. We were down 11, 12. So now that next big year, we're compounding from 90%. So we're getting 90% of that good next year, not 70%. So it's very important to manage drawdowns, to not get creamed. Okay, that modern portfolio theory is out the window now. It's sequence of returns actually has always been the good science, but that's what we're talking about. And so our portfolio doesn't fit the planning software. And by the way, if you're using that 4% rule, it makes, if you're not losing as much during bad years, you're only losing a third or 40%, then that 4% you take out every year from Pie Charts or Us planning is a bigger number. It's also a safer number. So the MAR ratio is your long-term returns divided by your maximum drawdown. Most pie charts, or almost all Pie Charts or Us, depending on how aggressive they are, they're going to be around 0.3, 0.4, 0.5 if you're lucky. But once you start getting over 0.85, you're an international fee. I mean, that is impressive by portfolio metrics. Okay? You approach 1 and you're a rock star. That's why we call them Obi-Don Kenobi, right? So we're actually coming at, so the planning software, we still have that. We still use it because we want to show you the baseline worst case scenario, although we've never had that, right? So we are actually now looking at trying to find a more, how do I put this, a better example, a more accurate example of how we're doing it. And we're actually trying to develop an AI model that would actually kind of mirror more to reality, more to what's happening. Because the planning software doesn't really let you go in and edit that. It's really hard to do, and they don't like doing it. And if they let you do it, then they wash their hands of it. So we'll show you the baseline, and then we'll show you how it really works, how it should work, and how it's a much safer ride. At Revere, we manage risk first, and the returns take care of themselves. Okay? It's not about total return, folks. It's about risk-adjusted return. So if you're beating Revere, if you're making more than 13% annualized long-term, and you must be, I would assume you're taking far more risk, or you're really good, maybe you ought to send in your resume, right? But because it's possible to just buy 2 or 3 stocks and hit a home run, but then you can also get creamed. We're not trying to gamble here. We're trying to make consistent long-term returns that with less drawdown that have a cumulative effect on the compounding. Remember, compounding works both ways. Wall Street always talks about the glory and godliness that is compounding to the upside, but they never, ever, ever talk about the Satanism that is compounding to the downside. The more you lose, the more you got to make back to get even. Okay? That's why it's important. And by the way, you want to send in your portfolio, you don't even have to give us your whole statement. All we need is an Excel spreadsheet with your tickers and either the dollar amount or percentage in your portfolio, and we can put it in our system. We can analyze how much risk you got and look at it and see. And with that, now, I'm going to send it over to Obi-Don Kenobi. And when I do, I want you to listen to him, and then I want you to listen to the team, Ted, Connor, and Todd. Does your advisor sound like that? Or does he want to go play golf or take you to lunch and say, the markets always come back? Does he farm out your stuff, or is he actively managing it? Do you have direct access to the portfolio guys if you have a question or two? You see, they farm it out or have their, somewhere in New York or whatever. The decisions are not made there. He's your, quote, relationship manager. And as soon as you walk out the door behind your back, he's called the asset gatherer. Hey, Bob, how much did you get? Hey, Susan, how much did you bring in? And then they farm it out, and to give you a pie charts or us, whether it's called the Lifestyles Fund, Target Date Fund, 60-40 balanced. Sometimes bonds are good, but when they're good, stocks are even better. But sometimes, especially during inflation times, they're more dangerous than stocks. You see, it's not about your risk tolerance and your time. I mean, it is a little bit, and that's why but it's more about the risk in the market, the sector, the stock itself, and the market's time frame. So you got to align your goals and your ambitions and your risk with that. So the risk of assets change over time with the environment. We dial up and down the risk all the time. So even if you tell me you're aggressive, if that stock is crashing and it's an aggressive stock, I'm not going to hold it for you just because you told me you're aggressive. When it's time to sell, it's time to sell. When it's time to buy, it's time to buy. Price is truth, no exceptions, period. So I ask you, what's in your portfolio? Ooh, that's our new we're getting that trademark, by the way. So with that, Don, how did I do, by the way? Did that explain the planning software dilemma?
Very well done, Dan. Very well done. In a kind, soothing tone of voice that would put anybody listening at ease.
Well,
and
thank you very
immediately
much.
make them pick up the phone and contact Revere Asset Management.
That's
what I
right.
do anyway. All right. So, Dan, a lot going on this week with the markets. So let's step back 2 weeks to the 1 day under the 50-day moving average that was caused by over the weekend Trump threatening to kick up tariffs on Europe.
Bob Greenland? No, I'm teasing.
It was over Greenland. It was, yeah. Next day, he walked it back in Davos in a speech. Market rallied for 5 straight days. Anytime the market rallies for 5 straight days, you expect some sort of a pullback. That 5-day rally went into FOMC Wednesday. Let's put up a 15-minute chart here. And here is where the FOMC meeting occurred, right? Very little volatility. When the statement came out, it was like a 98% chance there wasn't going to be a cut. There was no cut. There are no cuts forecasted over the next 2 meetings either. So far, so good. Into the close, decent, mild gap up Thursday morning, and then a very harsh sell-off. So we call these inflection points. So when something geopolitical or economically sensitive, something that's going to roil the markets occurs, the market will try to shake loose shares. There's always some sort of panic selling, but this was a pretty harsh sell-off Thursday morning. But look at the recovery in the afternoon, making it seem like really a non-event. But as an inflection point, it gives you a level to trade against. So that makes the lows of Thursday very critical. Those lows need to hold. One other critical thing about it is that it undercut and reclaimed our short-term moving average. The green line on here, that's the 21-day exponential moving average. We undercut that, but reclaimed it. So certainly.
And the red's 50?
The red's the 50. We certainly always want to hold the 21-day moving average on the S&P 500, which right now is at 69.22. We had a bit of, so overnight Thursday into Friday morning, it was announced that Trump is going to nominate Kevin Warsh for the new Fed chair. The markets opened down a little bit, and we're just chopping around. We're actually near the lows of the day. Lows of the day, 69.25, which is still above that 69.22 level that we held. That's the 21-day moving average. So the short-term moving average is holding for now on the S&P 500. But if you go to some of the other indexes, we also had a bunch of tech earnings this week. Microsoft, very weak. Meta, very strong. Tesla, mixed. Apple, down about 1%. SanDisk, the 4 horsemen of memory. SanDisk reported and was up over 20%. That's pulling back. There's a possibility, and Ted's going to talk about that, about a blow off top in a couple of key areas, but we'll wait until we get to his portion. So the inflection point on the NASDAQ 100 bounced at the 50-day moving average, reclaimed the 21-day moving average, and right now is holding above the 21-day moving average. There's been some relative strength over the last 2 weeks in the Mag 7 type names. So that's a positive overall for the S&P 500 and also obviously for the NASDAQ 100 because of their huge weights. RSP, this is the equal weight S&P 500, exhibiting relative strength going back to October when the relative strength in the NASDAQ 100 peaked. These, because of the heavy weights, these are going to move opposite of each other. If RSP is relatively strong, Qs are going to be relatively weak and vice versa. RSP bounced at the 21-day moving average 2 weeks ago. Notice how much stronger that was. We saw the S&P 500 and the NASDAQ 100 actually break their 50-day moving averages before bouncing. We're sitting right on the 21-day moving average right now on the equal weight S&P 500. It's a level that needs to hold. But yesterday, that big, the volatility event that we had, that inflection point, notice the RSP actually finished positive on the day and held the 21-day moving average. So what's that telling us? It's telling us that it was growth names and tech names that were weak. Because again, the RSP is equally weighted. You get the same weight for Microsoft, Apple, and Nvidia as you do the smallest stock in the S&P 500. But today the equal weight is sitting on the 21-day moving average, broke yesterday's low, so a minor penetration of that inflection point. Let's go on to the other indexes that we talk about all the time. This is the Dow. We're not as overly concerned about this because it's a value index. It's 30 stocks. It doesn't exhibit leadership. It's broken the 21-day moving average today. Let's go to the mid-cap index, the S&P 400. Undercut and reclaim the 21, breaking the 21-day moving average today. And the Russell 2000, which has been the leading index this year, a lot of money flowed here, also breaking the 21-day moving average. But again, note the relative strength. It's a somewhat normal pullback here, but there are a couple of signs that we look for. We want the relative strength line to stay above this orange line. That's the 21-day moving average line of the relative strength line. So we're piercing that, and we're also piercing the price line. All of these things add up to getting a little bit more defensive. Additionally, I've got 7, 8, 9 of my 21 over 21 for the week, breaking the 21-day moving average. This is a very key indicator. It's leading stocks across at least 10 sectors within the market, and that's obviously not a good sign when you've got that many breaking the 21-day moving average. Buys that we've done recently, we're not making much traction on. We're getting stopped for small losses, and we're seeing some names that we own that have been riding the 8-day moving average higher coming back and testing that level today. This all adds up. It's weight of the evidence. Nothing is perfect in the market. We're dealing in probabilities, not certainties. But this is bringing the market under a little bit of pressure.
Don,
going into today.
Could I ask
sure,
one?
Sure.
So we have a market call every morning about 45 minutes an hour before the market opens. Everybody goes through their favorite 3 long or short individual, then their favorite sector, and then we go around in the room and see what's happening. Don in his screens this morning, Don, you made a comment. I didn't say anything, but I want to say it on the show because everybody on the call knew what it meant. You said I'm seeing fewer leading stocks breaking out or holding than I was just a few days ago. So you're saying that the breadth is starting to wane and there's fewer stocks looking good, and that it leads probabilities to it being more bearish than bullish, right?
Not necessarily the overall breadth, but a certain decline in the number of leaders, which is what's important to us as a leading growth shop.
Picking stocks, yeah.
Right. So, we split the portfolio in half. We've got the index allocation that we maintain in different layers as long as we're above our short-term, medium-term, and long-term moving averages. That's holding fine for now. Need to hold the inflection point from Thursday Thursday morning's lows. On the other hand, we've got individual stocks, and they acted very well for the first 3 weeks of January for our portfolios, anyway. And now we're seeing relative weakness on those names, so we're keeping our stops. I went from owning 11 names to owning 8. By the end of the day, I'm probably going to own closer to 7, and also get stopped on some sector ETFs that we're holding. So the weight of the evidence shows a weakening in what we focus on, the pond that we fish in.
Right.
And if the indexes continue to hold up, then our portfolios will continue to hold up. We can still get a decent gain as long as those are holding up. If the growth stocks are not holding up, let's take a look at something that we really don't invest in. But this is XLP. This is Staples. Staples looking pretty darn good as of recent. And in fact, the Staples to the overall S&P ratio, I saw a chart on Twitter from All Star Charts, that was breaking out. That's a negative for growth because money doesn't pile into Staples unless you're looking to get defensive. So you can see XLP is up 0.5% today, while the S&P right now is down 0.5%. The growth half of the S&P is up 0.5%. The value half is down 0.3%. So again, we're showing.
I think you mean the other way around. I think you mean the growth is down and the value's up.
Growth is down 0.5. Value is down 0.3. So growth is down more. And Staples up 0.5%. This is defensive names outperforming the overall market. These are the little clues that we keep an eye on, and when you add them all up, they don't overcome price and action, but sometimes they point to what you need to look for or be wary of the price and volume action. And the price and volume action really hasn't been that good for growth names this week. So on our nightly trend gauge, we kept the yellow sub arrow for growth stocks on, even though we made a new high in the S&P 500, and we're shifting more toward neutral by the end of the day for that indicator, because that's what we're seeing. We just deal in facts, not opinions. We go around the room, like you said, every morning and every afternoon. In the morning, preparing for the first half of the trading day, in the afternoon, preparing for the close, and also discussion on what we're going to focus on the nightly video that we put out at night, including every trade that we do. And our portfolio allocations and our performance, along with the performance of the major indexes. The RG8, which is an 8 growth ETF composite that we track. It's a way of keeping our finger on the pulse of what is actually going on with growth names. The FFTY, that's the IBD 50, that's one of the components of it, is down 5% today. Ouch. IWO is down 1.9. ARK-K is down 2.4. This is all weight of the evidence pointing to a weak day in leading names, which is we kind of have been seeing over the past week, and talking about on the videos. When we get stopped out on something, we don't hide from it. It's actually part of the process, and we embrace it because we know long term we have a positive expectancy in our approach. And that positive expectancy means we're going to win about 40% of our trades, but our wins are going to be substantially larger than the small losses that we have 60% of the time. We have no problem losing. We pull the plug, we move on, we focus on what's working.
Last question, Don. Last question. Do you play golf during market hours?
I don't play golf even on weekends, but I want to get into it on weekends to get out and get more active in 2026. That's one of the things.
I was making the comment because I just wanted to know, folks, does your advisor sound like Don, or does he just want to go to lunch? During market hours, Don's not doing anything but in front of the computers, and so are the other 5 guys or so. So anyway, go ahead, Don. I'll stop interrupting. I can.
Yeah, we don't miss a whole lot, but that's what our clients expect. That's how we market ourselves, and that's what we're going to continue to do. And that's why we cleared $400 million in assets under management last week. So a big thank you to everybody that's come aboard and embraced the Revere approach to the markets. It's a common sense approach. which you change your clothes depending on what the weather's doing. Why shouldn't you change your portfolio depending on what the market's doing? Well, because the standard answer from Wall Street is because you can't time the market. We prove every night on video here that we don't expect to time it perfectly, but we get the trend right across 3 time frames. And when the trend is strongly at our back, then we go with growth names as well as a way to enhance the returns of the portfolio. And speaking of wind at our back, Ted's going to talk about 3 tickers that have had the wind at their back, but might be showing a few signs of that wind dying down. Take it away, Ted.
Thank you, Don. Can you please pull up SNDK as the first chart on your screen? We own, in both Grotection and Turbotection, we own SNDK right now for full disclaimer. I want to go back all the way to September 4th of 2025. That's when SNDK gapped out of its spin-off base into new all-time highs. I believe MU reported huge earnings. The market quickly realized that there's going to be a huge supply and demand imbalance in memory in the AI infrastructure build out, which is a critical component of building out data centers and the necessary infrastructure to power all these LLMs, agents, and more. So from that, it quickly ran up about 140%. And it started forming a high type flag. That's where we initiated our first trade in this name in Turbo, which we trailed against the AEMA until the break around November 19th, November 20th. From then, that huge shot to the bow led to this multi-month base that built out from November until the end of December. We then reinitiated a position in Turbo December 24th as it was building out this handle-ish type pattern above the 821, 50, and 200, all rising. And heading into New Year, it broke out on January 2nd and really hasn't looked back since. Just has just rode the AEMA all the way up in a controlled manner, controlled fashion. We did take a trim when it hit 10 ATRs above the 50 on January 21st, but then kept trailing the rest of the position against the AEMA. Today, well, yesterday, SNDK reported a blowout earnings quarter. Big beat, big raise, some of the biggest guidance raises we've seen. I believe they were expecting $4 in the next quarter, and now they're expecting $12 to $13. So just amazing beat and raise. The market continues to see huge demand in memory, but nothing in the markets can go on forever. So pretty much this was a controlled move, as you can see. Don, if you can draw an upward trend line connecting the peaks of this move, that was a controlled move at a 45-degree angle. Because of this earnings, it pretty much went straight into the 12 o'clock direction, vertical, breaking the upper trend line. Some other facts about this is it was almost 400% above the 200-day moving average at today's highs. It was over 150% above its 50, and it hit 20 ATR extension above the 50. I don't think I've ever seen that large of an extension in any stock I've ever traded or even studied. 20 ATR extension above the 50 is quite amazing. So we elected to trim another 50% of the remaining SNDK, looking at an intraday chart with really, it's called a 5-minute opening range break or through opening range lows. And so I was watching the 5-minute, and when we took out the low of the first 5-minute, that's when I decided to make that trim. And it coincided with the 650 half Livermore level as well. So right now we have about 1.5% left in Turbo. Don, you can chime in for position size you have and grow if you would like, but we're just going to let it trail the AEMA as far as it possibly can. If it closes below, we'll just sell the rest. But it's been a great move so far, and this is the first parabolic move of the year that I wanted to cover. The next one is gold. Gold futures paints a better picture because it trades 23 hours of the day versus GLD. So we own this in both Grotection and Turbo as well, and both these positions have contributed to our outperformance this year. Definitely in the right names and right themes. In a different scenario, if you pick the wrong stocks, it could have been a different outcome. But we're in the right themes, right names. This one, I can only speak for Turbo because I don't remember exactly where Don bought gold, but we initiated our position on November 24th. It was actually a pretty big position at 10%, but gold's a slow mover. We did sell some into strength on December 12th into the left side area because we did see some huge sell volume on the left side of the base. Obviously, in hindsight, that was probably not the wisest move, but in real time, we thought we oversized it. There were some other fast names moving at the time. And we also had gold miners, 2x leverage ETF at the time too. So we just wanted to peel a little bit off. Then we made a new all-time high in gold. And with that huge sell candle back into the base, breaking the 8, we decided to take another piece off. And from that, we just trailed the 8 and 21 EMAs all the way up. It was a controlled move until last week. It started accelerating. You can see there was 1, 2, 3, 4, 5, 6, 7, 8 days in a row, including yesterday, where gold finished green. And in GLD, if you had a 50-day moving average extension indicator, it flashed multiple times. But I was watching gold futures, and that flashed for the first time 10 ATR above the 50-day since the start of this entire move. Don, if you can go on a monthly chart here. The first time gold flashed 10 ATR extension above the 50-day moving average from this 10-year cup with handle breakout starting from early 2024. That was around the 5,600 level as well, and we decided to trim another 50% off there. For the rest, we're just trailing the 8 EMA, maybe the portion with a 21 EMA. A catalyst, a potential couple catalysts that did cause this reversal. Trump nominated Warsh, who's typically known as the more hawkish nominee, versus Hassett, who is the more dovish. At the same time, the dollar is starting to trickle higher a little bit. It reclaimed the big 96 level as well. So a combination of just too many people in gold, the move started accelerating with Warsh coming in as Fed chair, the dollar starting to curl, and then the CME final also increased their margin requirements on gold futures. So a lot of people over leveraging gold definitely had to sell because they increased the margin requirements. So that's what potentially could have caused this volatility so far. The final move is silver. Disclaimer, it's also owned in Turbo, but we only have about 10% of the original position left over. This also has been quite an incredible move, this precious metals area. We first initiated a position, and it was the only buy. The big mistake was not pyramiding more. We initiated on November 26th out of this multi-month cup with just a couple month cup with handle. And obviously, in hindsight, when it broke into all-time highs, should have pyramided there because this has rode the 8 EMA all the way up. And as Don says, I mean, nothing bad happens until you have a close below the 8. And the best trends also just ride the 8 EMA all the way up. So we made our first trim, though, on December either 26th or 27th when silver futures flashed that 10 ATR extension above the 50. Then we trailed the rest until a few days ago, actually. It was January 27th where silver futures triggered another 10 ATR extension above the 50. Trimmed more off there and holding about 10 to 12.5% of the original now. It's breaking the 8 EMA today, at least on the futures, and yeah, as well as on SLV. It's actually breaking the 21-day on SLV as well. On silver futures, though, it's still holding for now, so we're going to make our decision at the close whether to trim more or just completely close the position and call it a day there and take the profits. These are all three winners. I do want to go back to gold and nugget. You don't have to show the chart, Don. I just want to tell the listeners that we're not just only cherry picking winners here. We had both gold, GLD and GDX, or actually nugget. I pyramided onto nugget or GDX into new all-time highs. That was just a perfect cup with handle. That portion of it got shaken out, and we just closed the earlier buy as well. So that the earlier buy ended up being on profit, and then the later pyramids were a loss. And we missed out a pretty big move there on nugget, about 50% move. So that's it for my section. 3 parabolic moves that we've been participating in as a firm into 2026, which has really helped us have a great January and We just want to make sure we manage risk here, lock in those profits on our trailing positions, just so we can continue to compound the equity curve.
Yeah, my initial buy on gold was back on 11.11. I've held a 5% position this entire way, but breaking the 8-day exponential moving average today, I'll be selling at least half of it. Silver, I closed that a couple of weeks ago before the last what looked like a parabolic move higher and then reversal, which was in this area right here. This is actually the third what looked like to be a blow off top. Each time, what did it do? Just came back and one closed below the 8-day moving average, regained it, undercut and reclaimed the same day here, held it here, held it here, held it yesterday, but now a decisive break of the 8-day moving average. And that easy 8 system that we talk about for riding winners would have kept you in this the whole way until it breaks. And when it breaks hard. There are a lot of people that'll be bragging about their big moves in silver that they've held, but are they going to be smart enough to take off some of it and book some profits? Should this reversal stick? They're the only ones that can answer that question. SanDisk, I trimmed some after hours on the move higher, holding a very small piece of this with this big negative reversal today. I normally like the last part to be a defensive sell below the 8-day moving average, but I'm not sure there's a reason to really give it all the way down to the 8-day moving average, considering the reduced size and also the fact that that's another 17% down to the 8-day moving average. Great stuff, Ted. These are the types of things, that's why Grow and Turbo outperform the markets. And us talking about taking our profits is why our MAR ratios are near a 1. So great stuff. Let's take it over to Connor. He's going to talk about a few growth names, some of which are holding up. Take it away, Connor.
Yep. Thanks, Don. Yeah. So going to talk about 3 different setups that I am watching, and obviously need to have some market awareness. The market's got a lot more choppy lately. The feedback from our own recent trades hasn't been as good. So that's always a sign for us to be more selective, size down, risk less. But with that said, there are still a handful of stocks that are looking good and potentially actionable. And the first one is GLW. This is Corning. And this is an optical communications name, connectivity for AI. And what really started this big move was that gap up the other day was they announced a $6 billion multi-year deal with Meta for fiber optic cable to support the AI and data center build out. So it gapped out of a very well-defined base on huge volume. And then the following day it had earnings and it pulled back. But this is sometimes tend to see with stocks is it's the market and the traders digesting the news, and now it's starting to set up kind of that post earnings, post catalyst gap U-turn setup. So it held the top of the base, bounced right off the 8 EMA, and it's actually positive today in a rather weak tape. So again, it's showing relative strength, and it's got, in theme, strong fundamentals, and that news with Meta was quite big. So this is holding up quite well today. It's rounding out, held that 100 Livermore level, held the top of the base, bounced off the 8 EMA. So this one looks good heading into next week if the market stays strong. And then another one is AAOI. And this is a extremely choppy stock, and it kind of shows the type of environment that it's been. 2 days ago, it had a beautiful breakout on volume, out of a base, really everything that you look for. And then the following day, it was down, over 10%. But again, this is a high ATR name, high beta name. So that's in character of the stock. And then today, it's up almost 14%. Some of these optical names got a bid with, SanDisk gapping up. So it's been very choppy, but it's showing relative strength. It's following through today out of a nice base. This one It's more of a high beta AI data center infrastructure play. Still negative earnings, but that looks to be changing, and they've pretty explosive top line growth, and it's got a big base. So this is one to watch in the coming weeks if the market can stabilize and get into these higher beta names tend to do best, or always do best, when you have the market win behind your back. So if the market starts to trend and we see some breakout in the indexes, this could be a really nice winner. And then last name is SEI. This is in the power generation theme, which continues to be a very strong theme. This is more so of a turbotection name. You got GEV, which looks great. You have Bloom Energy, that looks great. And so I'm just watching this one to see if it can stage a breakout and follow through out of this pretty nice multi-month base. So short and sweet today, just 3 setups that I'm watching, and it's always dependent on the market. If the market starts to pull back, as we know, stocks are going to typically follow the market and need the wind behind our back.
Yeah, a good point about these. They are extremely volatile, and if you can find a spot on here that, other than right here, where buying this on strength wouldn't have got you stopped out within a couple of days. And that is why we talk all the time in-house about the best buys for high ATR names like this are on a pullback to support. If you buy this here, you can withstand a pullback and just trail the moving average up. If you buy it here, you broke the 21-day moving average 3 days later. If you bought it here, it pulled all the way back to the 21-day moving average. And I mean, this is like a double-digit ATR stock. Anytime you bought it on, unless you're swing trading and holding things for 2 or 3 days, and if you are, that's not what we do. But if that's what you do, that's great. But every time buying this on strength has been rewarded with a 2x4 to the back of the head within a couple of days. So these choppy stocks have to be position sized accordingly. Good stuff, Connor. Let's take it away to Todd, who's got 2 names that are showing leadership. But again, leadership is a little sketchy in this market, very stock dependent. Take it away, Todd.
Thanks, Don. I just want to say that one of my first segments going back to the early 2025 was a segment on the gold to silver ratio. And at that time, when I presented the gold to silver ratio, it was over 90 to 1. And that was really extreme by historical standards because gold had already started running in mid 24. And today we're back to about 50, which is right in line with the post 1970s average. So we certainly did a great job on the team of nailing that silver trade last year and started informing everyone extremely early on that situation. Anyhow, getting into a couple of the stocks I want to talk about. One just had earnings yesterday, and one is semi-related to this company and reports in a couple weeks. CAT is one of the companies involved in power generation, and most people think of Caterpillar as a heavy equipment company that makes bulldozers and backhoes. Well, there's 3 segments of this company. You've got the power and energy division, oil and gas, and mining. And all 3 of those businesses are strong right now. And what most people don't realize is the power generation division now makes up 40% of CAT's total business. And it is by far their fastest growing segment right now, which in the last quarter yesterday for the December quarter was up over 30% year over year. And this is a very bullish multi-year secular trend that they believe is going to double again by 2030. And again, the big tailwind here is all this new power coming online is being done behind the meter. And in this division, Caterpillar manufactures power turbines, and they also manufacture natural gas generators that run on natural gas engines. So that's an extremely strong division. They've just gotten a huge order for those natural gas engine generators. And that segues into their oil and gas business, which is also powering these generators, and they're the company that's doing the infrastructure for, the pipelines. They're doing a ton of business in natural gas compression, which compresses the natural gas as well as the wells to be able to transport natural gas. And finally, we all know what's going on in mining, everything from lithium, gold, silver, oil and gas, you name it. They've got three divisions that are really hitting and growing. So looking at this chart, yesterday we got an earnings surprise. They reported a 45-cent beat, over an 18% gain on revenues, and the stock had a gap open on some big volume. Don's doing some studies and work with a couple of our colleagues where on these gap ups, we're not necessarily buying them the first day, but we're developing a method and an algorithm to better handle these situations. And oftentimes we're looking to enter these on day 4 or 5 post gap up. So we had a decent gap up yesterday, closed mid-range. Today we're trading into that gap a little bit. So what we typically like to do is watch these for 2 or 3 more days and potentially put on a position. But overall, just wanted to bring this name up. Extremely strong trend, along with Bloom Energy, G Verona, Solaris that Connor talked about, and Fluence Energy, all extremely strong secular growth area. Another name, VRT, Veritiv. This company is also doing business with Caterpillar, where they're doing combined cooling and heat power capture. So they're taking the heat that's generated off the turbines and the engines, capturing that heat, and they're able to generate air conditioning, heat, and regeneration of additional power from steam turbines on top of that heat. So they're making these units approximately 90% efficient. Overall, Veritiv is building a nice double bottom base here. Just basically broke out into that double bottom base range. Has earnings in a couple weeks. But Caterpillar talked very highly about their relationship with Veritiv in this area. And again, Veritiv builds out the racks, the cooling that goes into the data center. So just wanted to bring up these two names and perhaps a little potential read through on the strong CAT numbers heading into the Veritiv numbers. Maybe this breaks out of that double bottom base and can get through those October highs. And that's all I have.
Good stuff, Todd. Appreciate it. Dan, glad to see you back in the chair, because every time I send it over to Spirited Dan to wrap up the show, I end up having to take a couple of throat lozenges afterwards. So glad you're sitting there to close us out.
Well, thank you, Don. My voice is so gravelly and hard. I've actually had this voice since I was 4th grade, 3rd grade. So, but anyway, listen, folks, thank you for listening today. And again, does your portfolio manager, does your financial advisor sound like these guys? Are they this qualified? Don't you want to go to a really good doctor? Well, you should go to a really good financial advisor that is a technician that knows what he's doing, not just an asset gatherer that's going to put you in pie charts or us. Folks, just go to our website, Revere Asset Management. There's a subscribe button in the right-hand corner if you want to tell a friend and neighbor. Right next to that, there's a Contact Us button, and you can send us an email for a complimentary portfolio review, questions, or if you want to onboard and become a client. And you can always, always, always call us at 855-REAL-WEALTH. We'll talk to you next week on Your Money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.